The forms related to assets used in your self-employment work. So the first form will be Form 4562 for Depreciation and Amortization. The second form is Form 4797, Sale of Business Property. The Form 4562, Depreciation and Amortization, is used to report self-employment depreciation and amortization expenses with your Schedule C and personal tax return. The Form 4562 is only used in the year depreciation or amortization first begins for the assets. So the year you place these assets in service, you will need to report on Form 4562. The total amount of depreciation and amortization then flow to Schedule C as a business expense to be deducted from income. Now, if you did not purchase any assets during the year and place any new assets into use during the year, then the total depreciation and amortization expense is simply reported on Schedule C, and Form 4562 does not need to be included. If you sell or otherwise dispose of a business asset during the year, then you must complete Form 4797 and report the gain or loss on your individual return, line 14, just like your net income or loss from your business. To calculate your gain or loss after disposing of an asset used for business, you must know your adjusted basis in the asset. In general, your adjusted basis in any asset begins with its cost basis. The cost basis includes the cost you paid to purchase the asset, plus any cost to get the asset ready for its intended use in your business, which could include shipping costs and installation costs you paid. Then, minus all depreciation ever taken on the asset on tax returns from the cost basis, which equals the current book value. Book value is also called your adjusted basis. To calculate the gain or loss, the book value is subtracted from the proceeds received. For more information on calculating a gain or loss, refer to Segment 5, Talk 2, Sale of Business Property. Now let's take a more detailed look at Form 4797. Part 1 reports the sale of property held for more than 1 year. Part 2 reports ordinary gains and losses, which means the assets were not held for more than 1 year and were not given preferential treatment. Lastly, Part 3 reports the calculation of recapturing depreciation, which applies to assets with a gain that have taken depreciation expense in the past. If we look back at Part 1 on line 2, I will cover the criteria that is needed to report each asset sale. First is a description of the property, the date the asset was acquired and the date sold, the gross sales price, which includes all proceeds you received when you disposed of the asset for any reason, all depreciation based on the depreciation rules calculated for that asset. Now, if the actual depreciation you have taken is greater than this amount, which could easily occur if you took additional depreciation like Section 179, report the actual amount you took here. But even if you did not take depreciation as required, at a minimum, you must report the amount that would have been required. The adjusted basis of the property is subtracted from the sales price, which equals the gain or loss in column G. If we look at Part 3, where most business assets with a gain will be reported, we can see the same information: description of the property, dates acquired and sold, calculation of gain, and then recapture calculations on the lines below.